Hello everyone, welcome to Just Invest Today. And today we're going to be talking about the different type of risks that us as investors are going to be faced in the market. And we have to learn about these two types of risks because it's very important that we don't lose money in the market. So when we invest, we got to find out what we're looking at, what we're going to do before we do the investment. Our number one goal as investors is to find out what that business is worth or the business that we want to invest in. We have to put a price on a business. And when we're putting a price on that business, we got to know the value. So when we're valuing a business, we got to find out what's the future cash flows of that business. And we got to predict that. And then we got to discount it back. And so when we do that, that comes with a lot of risk. And it can be business risk or stock market risk. When it comes to business risk, and when you put your hard earned money into investing into a stock, you got to think about it as you're owning a piece of that business. And with owning that piece of business comes with risk. And the first risk we got to actually think about and look at is the capital structure of that business. How much debt does that business have? Are they over leveraged? How are they using that debt? And do they have enough free cash flow to pay for that debt in the future? So we do not want a lot of businesses with a lot of debt because that's going to put a huge strain on a company, especially in these times where a lot of businesses are going bankrupt and they go bankrupt because they have a lot of debt. So we got to watch out for those type of things and those things that we're going to look for. And we're going to find that stuff on the balance sheet under long-term debt. And we got to make sure that this company is well balanced and it doesn't have a lot of debt, long-term or short-term, and it's being able to pay for that. The second business risk that we got to look out for is the capital requirements for the company and the nature of the business. So we want to know how much money is it going to take for this business to run effectively and how much money do they need to invest in the company and just to make the business run. And this is called the capital expenditures. And this is a very important concept because when we're looking at this business, the more capital it expends, the more capital that it needs, it's going to hurt our future cash flows. And we want a lot of cash coming into our pockets, into our business. And with capital intensive businesses, that's going to hurt our pockets and it's going to hurt what the cash of business is going to generate in the future. So we got to look out for that. A good example of this is airlines. The airline industry needs a lot of capital just to maintain it. How are you going to maintain the planes? We're going to teach the pilots. All the workers require a huge salary, and just the business to keep everything steady, everything going, it costs a lot. And then on top of that, the margins, the money that you make from the business is not that good. And the industry is very competitive. So this is what we're going to have to look out for before we invest into a company. Capital intensive businesses are just not going to cut it if we want our stocks to grow double, triple, and quadruple into the future. We got to look out for these things. They're very key. And lastly, for business risk, we want a business that's very predictable, low risk. So when we're looking for these low risk businesses, we need a business with a competitive advantage and very predictable. And we know what these businesses are, and you can find them when you're looking at the numbers in the balance sheet or the cash flows of a business. And even when you're going around and you're looking around, like businesses like Apple, like it has such a strong brand name, like it's hard to switch from the product. Like it just keeps generating cash flow and cash flow and cash flow. So these are the businesses that we're looking for. Very predictable, low risk businesses with a huge competitive advantage. And when we find a low risk business, we want to keep those businesses because a lot of businesses now they have a chance of going bankrupt, and we do not want that because we don't want to lose money in the market. So finding these very predictable businesses are going to be key to our investments. And lastly, the stock market risk. This is very key right now because we know everything's just wild, everything's up and down, especially during these times as the pandemic has been going on, and a lot of people in the market right now are having FOMO, and this is influencing a lot of decisions making right now. So we know another stock market risk is actually paying too much for a business. And we don't want to pay too much for a business because it's going to take longer to actually get that income out of that business. Because we know that the business has to follow the market eventually. Like, the business has to catch up to the market. So if you're gonna think that way, paying too much for a business, and if the cash flows are not up to the business yet, we're just gonna have to wait longer. We're paying a higher PE, a higher multiple for that business, and it's not gonna work out. So we gotta remember the concept of actually paying 50 cents for a dollar bill. We want to pay half off of what the business is actually worth. So that's the key thing to look out for. The stock market has been fluctuating from high and low, and we can still kind of find good companies in the market, but we got to make sure the value is higher than the price that you're actually paying in the market right now. As investors, we got to start looking at volatility as a good thing for us, because when there's a lot of volatility in the market, that means we can actually get cheaper prices. So when there's a lot of fear in the market, prices get cheaper, even though there's still really good low risk companies that we mentioned before. So when there's a lot of fear in the market, that's when we have to invest in the company and we have to buy stocks. You're not time to be scared and not time to be fearful. And then when there's a lot of greed in the market, that's when we kind of hold back because everyone's having FOMO. Everyone's thinking they found the next big stock to purchase and everything's going up, and then stocks will become expensive. So look at volatility as a good thing that's going to help us, not a bad thing. If you found this video helpful, please like the video, subscribe to my channel, and see you back in the next video. See you later. Bye.